Okay, let's get into this. You've probably seen the headlines, the tensions, particularly, in places like the Middle East. It's a lot to take in on a human level, obviously, but there's this other angle too, right? What does all this instability actually mean for your money, for the economy?
Exactly. And that's what we really wanted to dig into for this deep dive. We've looked at some analysis focusing specifically on how these geopolitical events, these conflicts, send ripples through the economy, basically connecting those big global headlines to, well, your financial world.
Right. So our mission here, using this analysis, is to understand those shock waves you mentioned, how conflicts shake things up globally. We're talking oil prices, transport costs, food, even things like gold and currencies. And then, crucially, bring it down to what it might mean for your investments.
And maybe the most useful part, what the analysis suggests about, practical steps, how you might navigate things when the financial seas get rough.
Okay, so let's start with those shock waves. The analysis we reviewed, it really drives home how connected everything is.
It really does. Geopolitical tension, especially in those really key regions, almost immediately hits global markets.
Yeah.
And one of the most direct effects pointed out, oil prices, straight away.
Right.
Any hint of supply disruption or just general nervousness, and you often see crude prices jump.
And we all feel that, don't we? Not just at the pump. It feeds into everything. Higher energy costs mean higher business costs, higher shipping costs.
Exactly, and that can push up food prices too. It's like a fundamental cost increase across the board.
Okay, what else? The analysis talked about gold, right? The classic reaction.
Yes, absolutely. Gold often acts as that safe haven. When things feel uncertain, when investors get nervous about stocks or other assets, they tend to shift money into gold. They see it as, a more stable place to park value.
So gold might climb when other things are shaky. Makes sense.
Yeah.
What about currencies? How do they react in this kind of environment?
Well, the analysis flagged a pretty common pattern. The U.S. dollar often gets stronger.
Ah, interesting. Why is that?
It's generally seen as a relative safe harbor for international capital, so money flows towards the dollar. But on the flip side, you might see currencies in emerging markets weaken a bit as that global appetite for risk kind of shrinks.
Okay, let's pivot now, bring it right back to your investment portfolio. The material we looked at was pretty clear here. Expect more volatility.
Definitely. That's a major takeaway. Stock markets can get really choppy. You can see sharp drops sometimes, just fueled by that uncertainty making investors pull back.
But it's not just everything goes down, is it? The analysis made that distinction.
No, that's a crucial point. It's much more nuanced. Different sectors react very differently. For instance, defense stocks, predictably, maybe. They often see gains when conflicts flare up.
Right.
But then industries that rely on people feeling confident, traveling, think leisure, hospitality, they tend to slump quite a bit.
Okay. And what about newer assets like cryptocurrencies? Did the analysis touch on Bitcoin?
It did, yeah. And the views there are pretty mixed, actually. Some people still talk about it as a potential digital safe haven, digital gold. But others point to its own high volatility and say, well, that's a huge risk in itself during a crisis. So it's not straightforward.
Yeah. Not a clear picture there.
Understanding these different reactions is really important, though. It helps you see beyond just markets are down to which parts are hit and how.
Which brings us nicely to the practical stuff. Based on this analysis, what can you actually do?
Well, a really fundamental piece of advice that came through loud and clear is diversification.
The old classic.
Yeah, but it's classic for a reason. Spreading your money across different types of assets, not just different stocks, can help cushion the blow if one area gets hit really hard.
Okay. Anything else specific?
The analysis also suggested maybe looking at assets that traditionally do better during instability, like gold, as we mentioned, or maybe other precious metals, leaning into that safe haven idea.
Right. Then holding some cash, that was mentioned too, which might sound a bit odd.
Right. Yeah, holding some cash or very stable, easy-to-access reserves. The thinking there is it gives you flexibility. And potentially, it lets you take advantage of opportunities if markets dip significantly but temporarily.
Ah, okay. So it's about having dry powder.
Exactly. Which ties into the big overarching message. Stay informed about what's happened economically, yes, but try really hard not to make impulsive decisions.
Like panic selling when things drop?
Precisely. Reacting emotionally often just means you lock in losses unnecessarily.
Okay, so let's wrap this up. The big picture. Global conflicts create real economic shockwaves hitting oil, gold, currencies, specific sectors. It creates volatility.
But understanding how it works, understanding those dynamics gives you a bit more power to make informed choices rather than just reacting to headlines.
And the main strategies highlighted were smart diversification across different asset types.
Like considering traditional safe havens like gold, maybe.
And keeping some cash or liquid reserves for flexibility.
And critically, staying informed but avoiding those knee-jerk, panic-driven moves.
Yeah. And that last point about not panicking, it leads to one final thought from the analysis, something to really chew on. It sort of suggested that these periods of high volatility, these market dips, they can sometimes create unique buying opportunities.
Right, for investors who are prepared, who are thinking longer term.
So, the question for you to consider, looking at all this, how do you balance managing the very real risks that are out there right now?
With potentially spotting and positioning for future opportunities that this kind of volatility might actually create. It's definitely a complex puzzle.
But hopefully, understanding the pieces like we discussed today is a good first step.